Okay, the purpose of this video is to show you how to do Unit 4, Activity 2, transactions 7 and 8, so the last two transactions. We'll be doing these together because they are the same style of adjustment. They are an amortization or depreciation adjustment, and it's called a declining balance. So if you just watched the last video, the one for transaction 6, we also did amortization or depreciation on that one, but it is a different style of depreciation or amortization. That was the straight line one. So basically, you buy a piece of equipment. In that case, it was machinery, and it lost its value over time in a linear fashion or a straight line. So if you graphed it, it would just go straight down to 0 over time. These two that we're doing for 7 and 8 are also depreciation amortization, but it's known as a declining balance. And so these are figured or calculated in a slightly different way than the straight line amortization. These don't go down to 0 in an exact straight pattern because it's based on a percentage that they depreciate or amortize over a given year. So 1 year, it'll, it'll depreciate by the same percentage every year, but since the value of the item is changing over time, you're basing that percentage off a different number every year. So it isn't a straight line all the way down. So that hopefully will be a little bit more clear as we go through these examples, and maybe you'll understand a little bit more what I'm talking about there. All right, so let's go ahead and look at number 7, and we can do this together and figure it out. So number 7, office equipment purchased for $30,000 January 1st, 2015 is amortized at the rate of 20% per year. So it loses 20% of its value every year, this office equipment. The accumulated amortization up to this point was $500. What is the entry for February 28th, 2015? Okay, so like our other examples, we're just trying to figure out for a month period. So we're not trying to figure out how much it's amortizing for the entire year. This office equipment, we're trying to figure out how much it is amortizing for a specific month. And in this case, it's February. So where we start with this is we look at our original value of the office equipment, which is $30,000. So I'm just going to put 30,000 down here just so we can see that. And then the amount that it's already lost in value through amortization through its first month of use is $500. And we get that from right here, the accumulated amortization up to this point. So that's the amount that it is already lost in value. So that's $500. And so for our calculation and for our purposes, this is going to be the first thing that we need to do. We need to figure out the present value of this office equipment after we figure in that $500 of value that it's already lost. So 30,000 minus $500 is, let's get our calculator. Probably should be able to do this without a calculator, but for illustrative purposes, I will use the calculator. So 29,500. So that's the value of the office equipment at the beginning of February. And so now what we're trying to do is figure out how much this is worth at the end of February. So we've got this new value, 29,500. And then the question is, what do we do now? And so this is where the amortization rate comes in, this percentage. So it loses 20% of its value every year. So what we're going to do is we're going to take that 29,500 and we are going to multiply it by 20%. Or if we're doing that in decimal form, 0.2. So right? So we're going to do 29,500 times 0.2. And that'll let us know how much this office equipment is amortizing over the entire year at this point. So 29,500, we've already got in our calculator. So I'm just going to multiply that by 20% or 0.2. And that'll give us $5,900. Okay, so that's the amount that the office equipment is going to lose over the entire year at 20%. But since we only want to find out how much this office equipment's value is going to change in the next month, or in, excuse me, the past month, February, we need to divide this number by 12. And that'll give us the monthly rate of amortization for February. We're dividing it by 12 because there are 12 months in the year, right? So we will go to our number again and we will divide by 12. And we get 491.6 recurring. So we'll call it 6.7. And so that's the number that we are interested in. Just putting these numbers in here so I remember them. 491.67. Okay, so that's our number. That's how much this office equipment is going to amortize or depreciate or lose in value over the month of February. And so now our journal entry is very similar, if not identical, to the ones that we did, or the one that we did for number 6. The only thing that changes is the name of the expense account and accumulated amortization account, because in number 6, we were talking about machinery, but in 7, we're talking about office equipment. So our debit is going to be amortization expense, office equipment. And this is the debit because this is an expense account, right? And anytime that we add to an expense account, that reduces the business's overall equity. So that is a debit. And we're going to put in our number that we calculated here, the 491.67. And that is the amount that we have lost out of the business due to the value of our office equipment going down or decreasing. So that is our debit. And then our credit is just like in number 6, it's our accumulated amortization account. And this is the accumulated amortization for the office equipment. So this is where we keep track of how much each specific item that we own has depreciated in value or amortized in value. Sorry. The only thing that changes there is the name of the account, because we're talking about office equipment this time rather than machinery. And we'll just indent that because it's going to be a credit. And the credit is the same number that we put in before, the 491.67. And so now we know that over the month of February, our office equipment has lost an additional $491.67 of value. And so what makes this one different than the straight line is this number will not be the same for March. We'll have to do the March calculation based on the amount that has been lost since January and February. So you'd have this $500 amount from January, 491.67 from February. You'd add those together, then you'd subtract them from the overall amount, and then you do what we did here again, and you get a new number that would probably be slightly less than this 491.67 amount. All right, so that's the difference in the straight line and the decline. Hopefully that makes sense. And then the third line, I've forgotten to do this in previous videos, so I won't forget to do it now. We just have to do our description of the transaction. And so I just put in to record February amortization. All right, so that is transaction 7. Moving on to transaction 8, it is the same style of adjustment and same style of amortization. It's the declining balance amortization. The only difference on this one is that instead of calculating for 1 month of amortization, we are calculating for 6 months of amortization. So it's the same basic process. There's just one small thing that we have to do at the end of our calculation to get 6 months rather than 12 months. So I'll show you how to do that. So if we look at our scenario here, or our transaction, number 8, a truck purchased for $20,000 has accumulated amortization of $6,000 on January 1st and is amortized at a rate of 10%. What's the entry for 6-month period ending June 30th? All right, so we'll do the same basic thing that we did before. We will grab the original amount. So the truck was purchased for $20,000. So I'm just going to put this off to the side so we can see it visually, hopefully. And then it has an accumulated amortization of $6,000. So our truck has already lost $6,000 in value. So I'm going to put that down here. And so then we come up with how much the truck is currently worth at the beginning of our 6-month period here. So it is now worth $14,000. I'm just going to load that into our calculator so it's ready. All right, so our truck is now worth $14,000. And so then what we do is we do the same next step that we did in transaction 7. So we just multiply our new value of the truck, or the current value of the truck, which is $14,000. And we multiply that by the yearly amortization rate, which in this case is 10%. So we multiply by 10%, or 0.1. And we'll see what that gives us. 14,000 times 0.1. That'll give us 1,400, 1,400. All right. And so that is the amount that this truck will amortize over the next year. And so now we want to do it for the 6-month period. So there's a couple of ways you can do this. You can multiply this number by 6 and then divide by 12. And that's effectively just saying that we're looking for 6/12 of the year, or 1/2 of the year. Probably the more simple way of doing this would be to multiply it by 0.5, meaning we're just looking for the amount that this is going to lose over half of the year rather than the full year. Remember, in this last one, we divided by 12 because we wanted to find out the month, how much it's per month. In this one, we're going to divide by 2, or multiply by 0.5, whatever you want to do. Okay, so, or additionally, you could multiply by 6 and then divide by 12, which is kind of a roundabout, weird way to do it. So I won't suggest that. The way I'm going to do it is I'm just going to divide this by 2, because we know that this is for the full year and we just want half the year. So We get our calculator and we divide that by 2. That gives us the amount that this truck is going to amortize over 6 months of the year, which is $700. So we're going to lose $700 in value on this truck over the next 6 months. And then we just load that into the journal the same way that we have for the past 2 amortization or depreciation transactions. Again, the only thing changing is the name of the account. This one will be truck. And this is our debit because it's an expense account. And when we add to an expense account, we debit it. Our accumulated amortization account to keep track of how much we've lost on this truck since the time that we bought it. And over the next 6 months, or the last 6 months, we lost $700 on this thing. And we will indent that. And then again, just our last line explaining what this transaction is, to record 6 months amortization. All right, so there you have it. And with that, we conclude all 8 of our transactions and the various different styles of adjustments that we've been introduced to. I hope this series of videos helped. Obviously, if I lost you at any point or you're not exactly sure why I did something, please feel free to send me a message or talk to me in class, and we'll try to sort it out and figure it out. But hopefully this was helpful, and I will see you next time.